So welcome everyone. Welcome to this Market Thursday, March the 24th. We'll be talking about the potential end of the US dollar as being the king dollar. So as we discussed a couple of weeks ago, the potential US recession, that was a bit of a catchy headline. And here this is the same with another catchy headline. You don't need necessarily to fall for it. This is just, try to open the debate. This is what I try to do during those sessions and during those webinars. So quickly running through, going through my CV. I started to work in 2000 as a cash equity trader in Paris. Then I joined the hedge fund here in London in 2004, where I worked for 4 years, running a long book, then a long short book. From 2009 to 2018, I was a prop trader at Infinity Capital Market, which is the UK subsidiary of First New York, which is a US trading firm in New York, where I had an absolute return mandate with no asset ranges and region constraints. Since 2014, I've been mentoring people and traders from all over the world. For another company until 2017. I restarted in 2018 on my own, launched in 2019 the 4x4 video series and mentoring as well. And since January of last year, I rejoined Infinity Capital Market as a prop trader. So doing very similar to what I used to do. No capital constraint, so pretty a very nice mandate. So today, what are we going to be covering? As always, we're going to be starting with the situation across asset classes, looking at stocks, credit, commodities, FX. So a quick market review, especially a bit about what has been happening over the last 10 days, recent performances. We're going to be discussing the stock rally. So we had the market, and the market is still ongoing and going higher. I'm talking the stock market. So we had a 7% move in 1 week from Monday, 10 days ago, lows at the close. So the story has quickly shifted from the Ukraine war to and low inflation, low interest rates. Whereas now we do have like high inflation, high interest rates, but similar high stock prices. So it feels very much like stocks, equities are the safe haven at any point in time. So that's something that we'll try to cover. We're going to be talking as well about what's going to happen next. As always, I'm looking for, like any of you, what are the next catalysts? So the next catalysts are the earnings. So the earnings will be starting as always with JP Morgan. I think is on the 12th, 13th or 14th of April. So that's really the start of the earnings season. So that's in 2 to 3 weeks. And we're going to be talking about the US dollar. Again, this is a catchy title, headline. Don't necessarily fall for it. This is when I'm asking for the end of its hegemony. It's more trying to find out what is the trend moving forward for the US dollar versus the other currencies. So quickly, in terms of the catalyst, I always like to start with it. So we had this massive rally that we're going to discuss later, which was partly pushed by the end of with the expiry that happened last Friday, where the gamma was at, I think it was 4,400 on the S&P. We went a bit higher, and we are still we still carry on. What is interesting is now is the tech is really outperforming. Today we had a massive day with Nvidia up 10%, Intel 7%, AMD 6%. So the SOX, the Philadelphia SOX semiconductor index, has been moving the market higher. And as well, what you had over the last 2 to 3 days. So we have seen again a lot of volumes and participation in calls. And when I say it's call options, so a lot of gamma squeeze. that has been done on names like GME, AMC. So all the meme stocks have been on the move. So the underlying is very stocks growth oriented. Feels very squeezy. In terms of really short-term catalyst, something that I started to discuss in the community, and I like to be looking always, especially as we are getting close to the end of the quarter, is the potential rebalancing of the mutual funds. So the mutual funds, as you know, who are most of the time doing 60% or 40% stocks and bonds. Stocks quarter on quarter are down 4 to 5% or a bit more if we are looking at the Nasdaq, but they are up on the month. And on the opposite of the spectrum, we get the bonds that get absolutely murdered. So the bonds yields have been massively up. So the US 10 years, which is at 235 roughly, there has been a big move on the bond market. And actually, that is one of the biggest moves that we're talking US bonds, but not only the biggest move for the bonds in the last 15 years. So if there is rebalancing, what you could see is mutual funds will have to be buying some bonds and selling some stocks for a quick reversion to the mean. What happens normally, it starts 5 days, 5 sessions before the end of the month. So that will be starting from tomorrow. So are we going to see a reversion? That's something that is a possibility. Today, flash PMIs we had as well in terms of macro. So those early leading indicator of the leading indicator with the flash PMIs, pretty strong in the US, pretty strong in Europe. So question mark on Europe, and because obviously Europe which will be much more impacted by the Ukraine war. But actually the US numbers were okay. So what about we start to talk with the asset class performances? The picture is more or less the same as we had a couple of weeks ago with the differential being here. Everything is up, let's say 5% versus a couple of weeks ago. So now we are at 4,500 on the S&P, 1,300 on the Nasdaq. Euro stocks 50, which is for Europe, has been underperforming the overall world. Emerging market have been bouncing quite nicely due to the Chinese stocks. So if you've been trading the market, if you've been trading names like Baba, like Didi, like Tencent, there has been a 40-50% bounce from last week. So very significant. I'm not going to say those are all the dodgy names, but the high beta stocks, as we're going to see later, have been, if the market moves up 10% from its lows, the high beta will be moving between 20 and 50%. And that is what has been happening. The currencies wise, so that's for here. Similar picture, the dollar has been stronger year to date, 3% versus most currencies. There has been a big move on the US dollar, Japanese yen, very, very big move. Now we are talking 122, something that we're going to be discussing at the end of this call. So we'll see later. Gold, WTI 52. Looking at the chart, we'll see that WTI bounced nicely from its 95 support. Week to date, the rally is still on, as I said before, since the lows on Monday of the week of the expiry at the close. The market has been, one-way traffic, really bouncing a lot, and it's still ongoing. The S&P now, the future is at 45.15. So the picture is the same, and the WTI moved by 25%. The sectors, the energy, really the only good spot at the start of this year, 40%. What is interesting is not only this year-to-date sector performances, but when we'll be looking at the next earnings that will be coming soon, if you take aside, put aside energy, there is probably not much to happen to expect from the earnings growth. Week to date, again, energy bouncing and still outperforming. So this sector, which has been quite a dog for many years and where many investors were underweight, is really on doing this strong move again and again. Quickly, looking at the bonds, and we should be spending more time. So if you've been trading bonds, I'm sorry, but I'm more a stock guy. But I'm looking at the bond market. So yields, bonds have been selling off really drastically, with yields on the move big time. I'm talking the whole yield curve, from literally the 2 to the 30 years, and a move of 10 bips week to date. That literally, if you look at the mortgage 30 years in the US, I think it's up almost 1.5% since the start of the year. So big moves. The VIX coming down, now getting close to, I'm not going to say something stupid, let me check if I got it here, 2169 now, so close to the low 20s. This is the market that is less of a trader market and more a portfolio manager market. So interesting, as we are getting closer to the average of the VIX over time, which is around 19%. Just I want to give you two charts before going into the real technical analysis. So here, this is the Egyptian pound, which I've seen a big devaluation at the start of this week. Why I'm putting those things is, try to give you ideas. I'm not pretending, to be generating 50 ideas every day. I'm just, putting some things that I'm seeing in the market, and then, if on top of this you can bring some good ideas, that would be brilliant. So here, this is the Egyptian pound, literally going from 16 to 18.5 roughly. So the valuation, what is it telling us is the war in Ukraine is really starting to not helping some part of the world. We know that Egypt is importing 80% plus of his wheat from Russia and Ukraine. So that is something that us, no matter what is your time frame, we should be looking in the next 6 to 12 months. That we know that any countries like in Africa, like emerging markets, which are depending massively on importing cereals, will be struggling in the next 6 to 18 months. So that is the part, if there's going to be tension in the market and those places. Another thing that I've shown you a couple of weeks ago, so this is the VIX in red, that this is for the implied volatility for the S&P 500, and in yellow we get the V2X index, which is for the Euro Stocks 50 implied volatility. And as we've seen recently, there has been a divergence between the two, for the right reason, which is the war in Ukraine is affecting much more Europe due to this its closeness to Ukraine and Russia. But if you look at that chart, you can see that literally the spread has been widening, and recently, as not that the war in Ukraine is getting better, don't get me wrong, it's just that the volatility across markets, not only the US but in Europe first, has been coming down quite a lot. And if you look at the Euro Stocks, where the lows were around 3,400, now we are almost at 3,800. So we've bounced quite nicely, 10% plus. And when you bounce in an oversold market, what happens is the volatility as well comes down quite a lot. Let's go into the chart. So I was just before the call looking at NVIDIA, because NVIDIA, as I just mentioned, has been on the tier. What we try to find as investors, as traders, is what are the leaders and the laggards in the market. After a sell-off in the market, you try, when the market sells off, everything sells off. when a market bounces, everything bounces normally. Okay, so then you adjust from the beta, and then when the dust settles a bit, you try to find the next leaders. So today, NVIDIA and the SOX index. So let me give you the SOX index up. Philadelphia bounced quite a lot. Why? Because there are expectations that the growth will be strong in that sector. So that has been the case since 2016, where the SOX has been outperforming the market. Today was a really, really big day in the overall sector. I haven't checked the volume of NVIDIA. Can I see there? So the volume on NVIDIA was 87 million versus an average volume of 40 million. So you have strong price action, strong volume, which is a good combination. It's not a trend yet because it's only a day, but what really the market was driven today is from those names. Looking at the S&P now, at the S&P future. So if you remember correctly, last couple of weeks ago, I said, and I was completely wrong, that if we were breaking, but we didn't break, the 4150, there was a chance that we're going to go into the 3900. Market has been bouncing on those support that you see here. My view was at that time that there was a good chance that we'll go lower with a slash, which was my gross and net exposure was very, very low. I have very little conviction. I still got very little conviction, not a lot of ideas. So if you got ideas, bring them to me. So now we are back to really bouncing. We've done those 400 points, so 10% one-way traffic non-stop. Feels a bit more squeezy from here. That is, if you look at the big picture, this is not the picture I do have. Many investors are probably like me, which is probably the reason why it's going higher. Too much gloom. Having said that, I don't have the cojones to build exposure. I don't like this thing, and I'm going to explain later why. But really strong move on the S&P, Nasdaq up, NQ1. Oh no, that's not the red. Q1, NQ up. This is the one. Nasdaq, same kind of picture where we broke this downtrend. We have been going up. Still, you can see from here that we haven't break on the way up the S&P. The move, the 200 moving average versus the S&P. We're above the 200 moving average now. So we went from very oversold to now, let's say, mixed to positive. I'm not going to do another one that I'm interested. I just wanted to give you. Yes, so this is the one. I'm looking at the Japanese Nikkei. You see as well the big move. So this is across indexes, very, very strong move. Another one that I'm looking, which is probably some of you are doing at the same thing. We see the home builders. So home builders not making new lows. So this is higher low. So this is not a negative. There are many negatives that are coming with the 30 years mortgage. But so far, actually the sector is holding pretty well. The picture versus the S&P is not the same. I just want to be discussing two. So yes, one of the stock that I'm looking at, maybe one of the ideas is Home Depot. So I'm looking at Home Depot. Unfortunately, the chart it will be on my Bloomberg, but I'm looking at an entry as a shorter on the 240. Why? Because I think due to the housing market coming lower and potentially moving lower. And as well, if you think about Home Depot is mostly about big tickets. I think those big tickets, any discretionary expenses will come down. So in the best case, in a really best case scenario, what I'll be looking is, potentially at a put spread. I looked at it yesterday. I looked at the 320. I think it was 320 to 80. The risk reward was not good for the time being. So those are the kind of of ideas that I'm looking. I'll look as well, like probably some of you, I'd look at Nike. Why I look at Nike? Because Nike came with their earnings a couple of days ago, where the outlook was okay, not bad, but the price action since the earnings, so it went up on the earnings, then the whole day it grind down, and now it's back to the levels before the announcement, and it has not been moving, price action as you would expect from a strong story. So question mark first on how stocks, companies that are going to be releasing their earnings are going to be doing in the near future, or is it just due to the Nike story that is, if you think about Nike, they do a lot of their production in and outsourcing in Asia, and that could be one of the reasons. But earnings, that is the thing that you'll be looking for as a question mark. I discussed before, I told you about the oil. This one I messed up. 95 was a good entry point. I traded a bit, and as always, I kind of fucked up on it. So I'm a bit sorry for my English. I'm swearing a lot, but 95 was a good re-entry price. Since then we have been up 20%. So look at this. My view is in the oil market, you need to be looking at the extreme move. So when you get a point and you are in between, so let's say you are thinking about buying it at 104, don't do that. Just wait for the big moves, because that in the oil market the moves are going to be bigger than usual. I was waiting for that move. Don't ask me why I didn't hold it, but that's the story of my life. US 2 years. 2 year, oh, sorry if I managed to do it. So where is it? That's the one. So US 2 years, we went to 220, back to 213. So you can see the move year to date, literally big move. So now what the market is saying is we expect the Fed to be very active. So we had the Fed meeting, so I should have mentioned that before, last week. Where they have been very hawkish. So now the consensus is probably for 50 bips rate hike in start of March, and another 50 bips in June. So we get 1% and probably another percent before the end of the year. So mechanically, the 2 years has been moving to this 2%, 2.5% very quickly. And the market really has been quick to react to that. 10 years now, if up the 10 years, this is the one. So 10 years, you see the move, you see the sell-off in bonds, 240, let's say 230, between 230 and 240, but literally over the last 10 days, we had 60 to 70 bips moves. That is just huge. Again, the month of March is probably one of the biggest move in terms of for bonds over the last 15 years. And that is one of the reasons, as we're going to discuss later, of we have seen some outflows from the bond into the equity market. I think this is it for technical analysis. And again, I'm not pretending to be a superhero in technical analysis. I always consider that this is one of the tools, but don't get me wrong, there are some others. Okay, we're back to our PowerPoint slides. Stock rally. So here, this is two charts that I'm using from Bloomberg to explain the recent move in the equity market. I'm using at the top, this is for the S&P. So those are the daily returns for the S&P, and at the bottom, this is for the NASDAQ daily returns. And you can see at the far right, this is the move. This is the weekly move. That is even better than the weekly move. You see can I do it up? Here, this is the weekly move for the S&P, and this is for the NASDAQ, where we had between 6 to 10%. If you look versus the percentage return, and versus the average, we are talking a 2 sigma plus. So this is quite something. A very, very big move. So that's, I think that really the market, as I said before, a couple of weeks ago and before, is the move are really, really big. The moves were really, really big. I had really low conviction of, my convictions was for the move to go lower. It didn't happen, but I said that I didn't want to have gross exposure because it could go both ways. And I think, one of the things that you learn as a prop trader is, the risk reward. Now, that tells you the magnitude of the move. What is interesting, if you look at the weekly performance from the lows of the Monday, the 11th, to the close on the 18th, everything, more or less, except China, S&P up 6%, Nasdaq 8%. So I think Nasdaq has been outperforming the S&P, Stock 600 7%, DAX 7%, CAC 7%. So what you see is, as the risk was very much seen as coming from Europe did the same as the market. What was interesting is, China really 27% from its lows. Why? Because there were fears that the ADR listed in, the Chinese ADR will be delisted. There were fears as well after the Russian stories and the delisting of the Russian stocks, that the Chinese stocks could follow. And that it happens in the meantime, where the US 10 years went from 199 to 215 and then, carried on to 235. So stocks have been really seen as the kind of safe haven. But in the long run, as always, what's going to matter and what matters is, as we're going to be looking after, is, is the valuation, the earnings. So we're going to be discussing about the earnings, what is the multiplier. And as well, if you think about it, when yields are going up, that means normally the discounted cash flows should be coming down. So here we have been literally moving from a market 6 months ago where low yields, everyone was saying low yields means high valuation for stocks, to now we get high yields, and it still should be over the last 7-10 days, what people have been saying, even high yields now means high valuation, as if, stocks were the only safe place in the world. So very interesting how quickly the narrative has been switching. What I found really interesting from this table, and this table is coming from Barclays, is looking at the flows of the last week. Okay, so two interesting data, which is, stocks, looking at US equity, which we have seen during the week of the 16th, 30 billion of inflow going into US equity. And guess what? That is mirroring almost exactly the outflows coming from the fixed income, around 27 billion. So in other words, all the money, the bonds selling off and yields going up, bonds selling off, tons of outflows. Those outflows have been reallocated through inflows to the stock market. Okay, so it's kind of, how do you call that in English? In French, that will be vase communicant. It goes from one way to another, and the level of water is the same. And that's what has been happening. So is it just about the flows? Mechanically, as well, as I said before, because of the expiry of that happened last Friday, we started to see from Monday, a squeeze, a gamma squeeze into the pin, which was at 4,400. So we went from 4,150 to 4,400 on the S&P. But you see as well that historically we have seen big outflows from fixed income into stocks. So this stock rally, and I just wanted to filter down even more. What has been in here, I'm looking from the 14th on the 22nd, I'm looking at the different sectors. You see that the ARC, up 28% versus the overall S&P up 8%. So tells you what? That the oversold stocks, the stocks that started to move down from November last year heavily and before, started to outperform the market over the last 10 days. So there has been a short squeeze. There have been people, reallocating money in the names that have been hammered. Does that mean this is a high quality move? Potentially not, but any squeeze will start with those kind of moves. So I've been in this business for long enough to know that you need to be careful when there is a move like this, even if the narrative is telling you that there is a war, that the earnings should come down. Price action is really important here. I don't have any I don't have any much exposure. I do have like a small short on the S&P, but I'm very humble so far. Look at this industry, how they have been moving. Again, ARC, social media, cloud, internet, really the outperformers versus the S&P, which is here. And the defensive that will be lower. Okay, so that's for stock rally. I just wanted to give you another slide, which is looking at since we touched the bottom on the 14, is how the different names have been behaving. So ARC in white here, which is at the top of the spectrum, up almost 20%. You see that it's outperforming massively. Again, the S&P, but everything has been following the same path with the beta adjusted, should I say? What about we jump into the earnings? Because at the end of the day, I keep on saying that every 2 weeks is what matters are the earnings. So I love Refinitiv. So Refinitiv will send you, if you're on their watch list, mailing list, sorry, every week these earnings expectations. So here we are mostly looking at how the Q4 2021 earnings were versus expectations. So I'm talking about the S&P 500 here, 76% were above expectation, okay, and 20% reported below expectations. So in a typical quarter, according to Refinitiv, 66% of the companies will be beating expectation, the estimates, and 20% will miss estimates. So what has been happening from the last quarter, and we know it already, or you should know it if you've been watching those webinars on YouTube before, is the last 4 to 5 quarters earnings have been better versus history in for US companies. So over the 4 quarters, the previous one, 84% of the companies were beating estimates, and only 13% were missing estimates. So even if we are above the average, the historical average, it is a bit coming down versus the previous year a bit. So the trend, and that's the same for the revenue versus expectations, where here we get 76% above and 23% below. To compare, 62% will be on average and 38% below on average. And over the last 4 quarters, we are talking 79% here and 21% here. Oops. So trend is a bit lower. So there is really a question mark, is what is going to happen in the next 2 quarters in terms of earnings growth and sales growth. So here we are talking about the expectations for the S&P for Q1 2022, looking at the earnings. So that would be for last year, and the expectation, so we should be putting expectations here. We go from $408 to $435, which is a growth of 6.5%. So, but what is really interesting, and that goes back to the sectors analysis that we've done before. If you put aside the energy sector, okay, so this one, yep, so which you get a $20 difference. If you put aside this $20 difference, you only grow up by $6, okay, or $7, okay. So here you get $20 delta, whereas here you get really 26.5, okay. So the delta X energy is around $6. In other words, if you put energy aside, expectations in terms of earnings growth are only for 1.3% or 1.51% growth for the earnings. So there is not much to expect from the market X, or not the market, for the companies X X oil, X energy. Here I'm taking some data from Bloomberg. So that's the year on year where we get the growth as well. So that's the earnings per share. So that's the actual for next year and the year after, where we go from 194 to 227 for this year, and then 246. So 8%, 10%. Market is still expecting for the S&P 500 roughly between 7-10% earnings growth for the next 2 years. So on one hand, you can argue that because the energy sector and some other sectors came from having no earnings in 2020 to low earnings in 2021, that suddenly those earnings could come up. And actually, most of this growth is going to come from those sectors, but that is still quite an aggressive expectations if we consider that there is a chance that the world is going to be slowing massively. So if you look at something that we mentioned before, that was last week, but the potential US recession, some indicators are giving us, 50% chance that, the US economy could go into recession. Can we have a 7 to 10% earnings growth, which is very similar to the average growth of the S&P? That sounds a bit tricky. So is it a question of, earnings expectation will have to come down in the near future? So here I'm just taking the earnings for the quarter on quarter. So this is for the estimate here. Then Q plus 1, Q plus 2, so 3%, 7%, 5%. So if we got 3, 7, and 5, that is still far from the 7-10% that you have for the year, even if that is true that most of the earnings growth is coming and is tilted to the end of the year. Still, expectations could be coming down. And why I'm saying that is I want to link this conversation with what we discussed 10 minutes ago, which was about the Nike price action. So Nike came with their earnings, stock in the morning, opened nicely, then started to come down because what they said is the expectation was not like very good. The report was okay, but the expectations, the outlook was not great. So as we are coming into next month, and the start of the Q1 earnings season, really there is a question of how these earnings is gonna play out. So far, most of the time the market gets saved by good earnings, and really here there is a good and a big question mark. So now I want to discuss the end of the US dollar hegemony. Again, that is an aggressive headline, and I'm pretty sure that some people will be very upset about it. But look, this is I'm just trying to open the debate here, and I'm not pretending anything else. We all get, different skills, different time frame. What I try to do is, help people with that. I'm not pretending to be the best analyst. I'm not pretending to be the best trader, anything like this, or the big macro. But to me, it's a way to create idea, not only for me, but hopefully for you. So I'm talking about the end of the US dollar and its hegemony is the dollar has been very, very strong. So I always got a bit of a tendency to be a contrarian when I look at something, especially when it's making all the headlines. So when you get a crisis like we have these days with the Ukraine war, is the first reaction of many market participants is to go for safe haven. Okay, and one of the safe haven, and that has been the case since 1970, with the early 70s, is really you go for the US dollar. Okay, so you buy US dollar, and the US dollar will be outperforming most currencies. Okay, so year to date we have 3%, but these days And again, it's only headlines and only talks, but, we've seen some talks about Aramco saying, the Saudi saying, we, with China, we are okay, and probably we could be diversify our currencies and go with less dollar. Okay, so what about you're gonna have less dollar and more renminbi? Same with Putin, which obviously is a bit in the corner and trying to do as much as he can, saying what about you pay me in ruble for my gas? So even if it's some part of the world, which have been doing, let's say, so business, there is a trend underneath that as the US dollar has been due to the strength of the US economy. So here we are looking at the percentage of the world GDP of the US in green, China in yellow, European Union in blue, and Japan in red. So as you can see now these days, US makes roughly 25% of the world GDP. China is very close to Europe, around 17, 18%, but China is growing, whereas Europe is coming down as the percentage of the world GDP. And really the big underperformer since the 90s has been Japan, which went from double digit 18% to single digit now. So as the US economy is the biggest economy in the world, most of the, so here we got the chart on the left-hand side with the US GDP as a part of the world GDP, and in yellow for China. And I put the same scale just to give you an indication, but you can see how quickly China has been moving. And I'm not, I'm not saying already, people are going to be moving their reserves from China, from US dollar into renminbi. Okay, what I'm trying to figure out is, if you've done a bit of research, and that's something that I explained in the 4x4 video series, is we know that the US dollar is making 88% roughly of any trades, currency trades. Okay, it's on one side of 88% of any trades. Okay, so if you look at there is always an interesting paper which is from the BIS. So if you go on the BIS, and they're gonna have, I think it's their every 2 or 3 or 4 years they do their FX reviews, and they explain what has been the trend of the different currencies dealing. So the US dollar, for that reason, has been a very strong, the biggest part of any central bank reserves. So here we are looking at the chart. You can see here that we are talking 60% for the US dollar. Euro is around 20%. And in green, we do have some others, So the question is not what is the existing position. We know that the US dollar is the strongest currency in the world. If you go to Asia, if you go in Asia, if you go in Africa, if you go in South America, they will take your dollar. Will they take any other currencies? Maybe slowly, but the reality is the dollar is the strongest one. But what is more important is what is the way moving forward. If you're making 88% of any transaction, and if you make 60% of all the reserves, what is important is what is the marginal, what is going to happen next. Okay, what about the next deal? And we know that with what is happening recently with Ukraine, with China getting better, should I say bigger, the trend is potentially for the new trades, for the new reserves to be not that much, not as much in dollar. So what I'm interested is the trend moving forward. So here there's a chart which is looking at the Israel FX reserves. So it used to be only dollar. It has been trending down. So here there is a question mark. We still don't know what are the reasons, and if there is if it's just a typo and everything is going to come back into the 90% plus. But it tells you again the potential of the marginal new reserves. So what's going to happen in the next years, decades about the US dollar. It's very similar to when you get a position of 80% of of the market share, can you keep those market share? And that's the same question with the US dollar. So if you think about the short term of the US dollar, I was saying at the start of the year, and I'm on tape and I'm fine with it, you know, at 112.50, you know, I thought it was a good buy versus the euro with a 109.50 stop. So, you know, I'm stopped out. So short term, you know, we know what happened to the US dollar outperformed versus most currencies, 3%, not necessarily versus the renminbi. So it has been very strong versus why? Because of the risk off. Now, you know, we know that the market is now, as we've seen just before, that the market is potentially pricing what the Fed is going to be doing. Okay, so the US, the 2 years is above 2%, similar for the 10 years. So it feels that short-term, mid-term, let's say short-term, 1 to 3 months, we are probably peaking in the Fed expectations, and the dollar as well is probably going to be peaking versus many currencies. Okay, so that's your short-term trend. In the long-term trend, and that's something that people have been calling for years and years. So when I say, you know, I'm really asking the question: is it the peak of the US dollar? If you go from 80%, if you get blocks like Russia, like China, like some countries in the Middle East that are saying, you know, we are keen more and more to deal with other currencies and have them as reserves. That means the dollar as part of the new trades is going to be lower. For those of you, obviously, for the new generation, obviously that's going to help cryptocurrencies as well. That is pretty obvious. There was a headline today, I think it was from someone from the central banks of Russia or close, saying, you know, we are keen on not only being paid in ruble for gas, but, you know, we're keen on cryptocurrencies because they want as much as possible to for many people to move away from the US dollar. Is it going to happen? No, it's not going to happen overnight. But, you know, if you want to do business, you can argue that it feels like the Chinese, that India is ready to be buying oil from Russia, and probably potentially they will be paying either in renminbi or they will be paying in ruble, but that's going to be potentially non-US dollar. Okay, so that's the trend. Looking at the different charts here. So here I'm looking at the DXY. So I think it's going to be peaking soon. We are talking, you know, potentially 2 to 3% max, with, you know, potential, you know, as a trader again. So this is the move here versus the move here. Okay, so you see the risk reward. That is even more true if you look at the euro dollar. So euro dollar, I was saying, you know, we should be holding above this trend. We didn't. This is why I got stopped. This is why, you know, I consider that risk management is key. What is my downside here? You know, potentially is 105. Okay, so, you know, 4 to 5%. I took a 3% stop loss. That is fine. I can live with it. But, you know, if there is a longer term trend, you know, this is potentially what you have. So I'm always thinking, what is my risk reward? And I'm trying to position and find the best risk reward with trades. Looking versus, you know, because I have some followers tonight and on YouTube, you know, that are in sterling, trading in sterling. So this is the trend versus sterling. This is the trend. What you have here is, for the time being, the trend is for the US dollar to be stronger. Okay, so don't go necessarily against the trend now. It is the midterm trend. But, you know, if we get a break of all those trends, I think that will be the time to pull the trigger. Now, you know, looking at the versus the Japanese yen. So that is, so we have been discussing quite a lot of the Japanese yen on the community because, you know, the yen really weakened quite a lot. So we went from 115 to 122. So that was as of yesterday, but, you know, we are talking 122 now. So the Japanese yen, which before this crisis used to be, you know, really the safe haven. So, you know, when you get a big crisis, you were going with the Japanese yen. What has been happening for several reasons is because, you know, first, Japan is importing a lot of commodities, so that means they're going to be suffering quite a lot with inflation coming. And more importantly, if you think about the divergence between central bank's policy, where you get the Fed, which has been saying there is too much inflation, we are very hawkish, we're going to reduce the balance sheet, yields have been going up, and on the other hand, you get the Bank of Japan saying, you know, it's fine, you know, we don't have that much inflation, so we're still going to do low yields, 0% on the 10 years, and we're not going to be reducing the balance sheet. So there is, if you think in terms of carry trade, which is the differential between the US 10 years and the Japanese 10 years, there has been quite a strong carry trade these days. And now it feels a bit like there is a panic sell. I don't know where it's going to stop. I'm not good enough. I'm not an expert in FX. But, you know, many macro guys have been looking at it. Really, we are talking about a big pair, and so we are talking 5% move in 2 weeks. So if you look at this move versus historical ATR versus historical volatility, that is pretty big. But as always with currencies, when those things start to move, it moves big. Okay, so that's for the US dollar. As always, so here this is for the renminbi. Actually, as you see, the renminbi has been behaving very well versus the US dollar. So that is interesting to see how the potential new blocks between part of the world, Russia, you know, China, and to a lesser extent India, will be making those currencies. What I would like to say is, again, this is for ID generation. I'm not a macro guy. If you are looking for some, you know, macro expert, there are tons of them. I'm just trying to generate ideas from them, from here, and trying to think, you know, no matter what is my time frame, is, you know, trying to find ideas that could be playing with it. So if you are offended by the title of those ideas, don't be. There's no need. We're just here to try. We are traders. Really, as being traders, we try as much as possible to generate ideas, and we share ideas. Okay, so this is why I love this community so much, the one that we are building together, because this is what I want to do. So what I can help you, if you think that I can help you, is 3 different levels. We got the trading community now. So we got 80 plus traders. We are sharing ideas. We are sharing long, short infrastructure, how to generate ideas, the process. I like it very much. So it's building. I got the 4x4 video series that I built in 2019. And it's based on my experience of 20 years experience as a trader, portfolio manager, and from my previous experience in another company as a trading educator. And I do mentoring, which is 101 Zoom session now, because now we move from Skype into Zoom. That's the new world, and where I help you getting an investment process and getting ID generation, and more importantly, with your money, building your portfolio. So this is what I do. If you get question, then we go into the next slide. You can send an email to greg@duponttrading.com, or you can go on the website and discover if you like it or not. Okay, I think this is it for today. Should we go through some questions? I got some questions. I got some questions about I think this is the index rebalancing. So the index rebalancing, so what has been happening is, if you get 60-40% exposure, and on the months, your bonds have been coming down more than your equities, which is the case now. So let's say bonds are down 2% when equities are up 2%. That means your exposure in bonds is too small versus what it should be. So mechanically, you buy the bond and you sell the stocks. And that is what is normally happening when we do index rebalancing. And that happens at the end of the quarter and the end of the year. So normally end of the quarter, end of the year, and end of the month. What we could see here, starting from tomorrow, 5 days before 5 sessions before the end of the month, is some kind of rebalancing, reversion to the mean. Okay. Should we invest in the Chinese ADR? I don't have any so ADR as shares that are run in the Bermudas most of the time. What I've been telling, and I'm on record for months and months and months and months, is when I joined my hedge fund in London, we used to be invested in Eastern Europe. And what I learned from the bosses there is, you always need to apply a discount to emerging markets. So if you are looking, let's say, at a stock that was trading on 20 times earnings in Europe, you will say that you will expect, your Eastern European stock to be trading, with a 30% discount. And I think that's the same with China. I've been saying, with BABA, with all those stocks, use a 20-30% discount versus the non-emerging markets, because this is, you don't have the same quality of data, especially going from China. Don't get offended. And the ADR listing and the listing, we know that it could be as well a political weapon. So the numbers, you can't really trust them. You still have the overhang of them, they're listing the shares. But in the meantime, you can argue that, we're not only long-term investors, we can do as well a lot of active trading. So I know that at Infinity, for instance, there are many successful ADR traders, which have been doing very, very well over the last couple of weeks, because the trade is really to be trading the Hong Kong listed names versus the US listed names. Okay, so that means probably you don't sleep that much, but you can be making a lot of money trading the arbitrage, and you're not pretending that you're going to be holding the position for more than 24 hours or 48 hours. Roger, I got a question for you. Do you have a view on gold? So gold, I think it's at 1930 something. So it went to 2060 last week or a couple of weeks ago. So if you look at the chart, we went from, if it breaks the 2060, it looks really good, to now, is it a potential double top? My view, Roger, is unfortunately, I don't like the gold. And that has been my history for the last 20 years. I understand, it could help versus inflation and everything, but I still want to believe that if that's the end of the world and I get some gold, I don't know what to do with my gold if I go in the street. So my view on gold is really shit. It's not really going to help you. I think there are tons and tons of good ideas. And if I want to be trading gold, potentially I want to be trading, gold miners and stocks that I think are going to be moving even more than the gold. So that's, I'm not helping you, Roger. I'm sorry with that, but gold, I'm not a big fan. I know that many retail traders will be starting with FX and gold. And now these days is probably crypto, but gold, I think there are always better hedges than the gold. And as we've seen recently, if you've been long, uranium, if you've been long cereals, if you've been long all those names, have been working much better than gold. So 95% of the time, you'll be finding much better hedges than the gold. Okay, so I think this is it for today. Next session we'll try to do in a couple of weeks, if I'm not too lazy. I hope it helps. If you got any questions, if you got interest in the 4x4, if you got interest in the mentoring, or if you've been watching today or watching later on YouTube and you like it, give me a like. That's something that helps for the to give me some strength, and as well to attract more people. So really, if we can grow all together, that will be really nice. Thank you for those of you who are joining tonight and for those of you who are watching right now on YouTube. And I hope to see you very soon. All the best, everyone. Bye-bye.